What is the best tax structure that you should use when you are about to flip a property? Well, great question, and that is answered by Louise and I in this video. Who's asked best structure for a limited company partnership for flipping properties. So why don't you describe what a flip of a property is first of all?
Absolutely. So thanks, Aidan, for a lovely question. So we tend to talk about property income being generated typically from one of two key sources, either renting it out or buying something, perhaps doing it up or getting planning permission and then selling it on at a profit. And it's that latter that is often described as a flip, property flip. So you buy it and flip it almost immediate on purchase. So in terms of the best structure, the key thing to keep in your mind's eye is that when you flip a property, you're never renting it out, and therefore it's going to be taxed. If you do it in your personal name, it's going to be taxed under income tax rules. In a limited company, income tax and capital gains tax are at the same rate, currently corporation tax rate. So it really doesn't matter whether it is a flip or it's a rental income and you've then sold on the asset, because the tax is the same value. And that brings me very neatly and nicely onto, well, actually, what is the best structure? So more often than not, for many of our clients who already have other forms of income in their personal name, it's best to do a flip inside a limited company. And that's actually for two reasons, one of which is tax and one is nothing to do with tax. Now, I'm going to start with the nothing to do with tax first, because to my mind, it's the one that's probably the most important and the one that probably tips the decision as to whether it is a limited company that's used. And that is all to do with risk. Typically, I see most clients when they do flips can be a little bit more involved perhaps than a rental activity. There's often a lot of renovation work to be done. There's a lot of activity to be done. And then, of course, you're looking for buyers. Those types of activities might be more inherently risky in terms of finding the right people, or indeed, having walls fall down around you when you're not expecting it. Note to self, don't give Simon a hammer on a wall that happens to be load bearing enough.
There is a broadband connection which is going to get the hammer.
I'm sure there is, but tends to be slightly more risky, and you'll pay much higher insurance as well on a flip. To make sure that obviously all the items are taken care of as need to be. As a consequence, most of our clients choose to keep that risk very neatly tied up in a limited company, because so long as you're not giving personal guarantees, then if something were to go wrong, and of course nobody wants anything to go wrong, but if it were, and perhaps you were to be sued, so to speak, it's not you being sued, it's your limited company. And I know that's a really negative way of looking at it. But in terms of protecting all the other assets that you've built up over time, all the blood, sweat and tears you've put into doing so, keeping something that is perhaps more risky than any other activity you're doing in your life as a separate legal entity and ring-fenced away from everything else is more often than not a really good thing. Now, the second key reason to do it is because, of course, if you already do have a fair amount of income in your personal name, let's say somewhere between £40,000 and £50,000, chances are when you sell the property, if it were in your personal name, you're going to pick up higher rate tax. Well, that's at 40%. Let's not forget, though, there's also national insurance, self-employment to pay on top of that. So you could be kissing goodbye to 51% of the profit you've made. Not great. Whereas in a limited company, it's perhaps going to be 20%, really, 19% currently, 25% if you hit the various bands that you need to for the new corporation tax rate that's coming in relatively soon. So do you want to pay 51% or 25% tax? And that's often a no-brainer answer. So for me, often a limited company is a great solution, but it's always horses for courses. You need to walk through your particular circumstances to really understand where it's best for you.
And that's a good answer to start with, isn't it? I guess the other issues that we won't go into tonight is around limited companies, whereby people open a limited company, close down the limited company to claim entrepreneurs relief, or what they now call business asset disposal relief, or BADA. Jinx. But you have to be careful of that because of TAR, which is it's not a colloquialism for thank you. What does TAR stand for?
Targeted Anti-avoidance Rules. So you can find yourself on the sharp end of a 51% tax bill if you're not careful. If you repeatedly open, do the work and close businesses pretty much doing the same or similar activity. And I use that phrase, same or similar, as a reflection on what the actual tax rules say, which is very ambiguous, very broad, very wide. It is what it is. I didn't write those rules, but you have to be very careful.
I've noticed that we're pretty bright on this screen tonight.
Well, it is Christmas time, shining bright.
Shiny bright with the sunshine. So that's some good questions on that one. Let's move over to Aidan's other question, which is VAT for commercial to residential. So why is it that people, first of all, whilst we're talking about this whole VAT commercial to residential, why is it a good idea to buy a commercial building like an office or a dentist? I'll talk about that in a second. Have you noticed that when you go past the dentist, it looks like a house? Go figure. It was most times. Why is it advantageous to buy a commercial building that you then convert into a home? What first tax do you pay?
Oh, well, the first tax you save a lot of money on is stamp duty land tax. SDLT, as it's often referred to, has two different rates: residential rates and, get ready, non-residential rates. Now, non-residential rates are a significantly lower value of SDLT than residential. So if you buy a property that falls into the category of non-residential, you're going to save yourself a lot of money on the SDLT to start with.
Absolutely. And then when you've got a commercial building, convert it to residential, typically what you have to watch out for on the commercial building, the downside to this is the fact that you've got potential VAT. So when a seller of a commercial building has a building, they could opt it to tax. I'm not going to get too technical, but opt to tax basically means that they may charge you VAT on the building. So £100,000 building, add 20% VAT, there's £20,000 VAT, £120,000. And typically what you have to also be careful of is that there's tax on tax. Why do I say tax on tax? Any idea?
Well, there's lots of ideas, but go on, share.
Okay. So tax on tax, what I mean by that is you have the VAT, which is 20%, but then you pay stamp duty land tax based on the total purchase value of a commercial building. So
including
you're buying,
the VAT.
Yeah, so the value of the building plus the VAT. So it can be quite expensive from that side of things. So from that side of things, you've also then got to think about, well, if I'm converting from commercial to residential, can I get out of it? And you can use different forms to remove the VAT on that commercial building. You do need to get the approval from the seller to do that. Not everyone wants to do that. And why is that? Why don't sellers they're not willing to really cooperate?
Well, sometimes it's because they don't understand it, and people rightly and often fear what they don't know. So they don't want the extra hassle of having to sign forms that might tie them up to the VAT man in a way that they weren't expecting. There's also an issue that if you've, as the owner of the building that is selling it, if they've agreed to do a particular type of scheme, a VAT scheme, then if they sell the property within the first 10 years of starting that VAT scheme, they have to pay all the VAT reclaim that they secured right at the beginning of that VAT scheme back to HMRC. And most people don't want to do that because it's not small amounts of money that this particular scheme covers. So are they prepared to work with you and fill that form in and end up with a bigger VAT bill because they've got to do the reclaim? Or are they just going to sell that property to someone who doesn't ask difficult and enthralling questions to do with VAT?
Yeah, and most times people say don't understand it. So what they don't understand, they just kind of dismiss it. The other side to that is then when you're converting commercial to residential, you'll have building materials and you'll have labour. And if you're converting from commercial to residential, there are two types of VAT that you might need to consider. There's the 0% VAT item, which basically means that you're making a dwelling for the first time and then selling it. There is a possibility of reducing VAT from 20% on all building materials and labour from that 20 to 0. But if you're going to be renting out that said property, then it's going to be just 5%. I'm not sure why I was doing my hands like this, by the way. I just noticed I had to stop myself. So you would have a reduction of VAT, but there are so many upsides of doing a conversion of a commercial building into residential. But there are so many trip-ups as well, so please do be careful. We've seen a lot of clients actually get that wrong, whereby they go for a 0% VAT scheme, but then they don't register with VAT. We just had one client where HMRC said no and refused the 0%, so they couldn't claim back the VAT because they was late with the registration. So that's a real shame. But you do need to act when you get the advice, and that's always a danger with anything like this, unfortunately.
When you are getting involved in this kind of activity, go talk to your tax advisor, because if you don't fill in forms, as Simon says, in a particular timescale in the process of buying, even before you've bought the asset, you might find yourself precluded from actually claiming some of those amazing reliefs that are out there. You just need to really make sure you understand every step of the journey way before you commit to buying, if you can.
It kind of sounds like a police record. Every step you take. Is that the wrong band?
Oh dear.
Yeah.